All right, so let's face it. If you've been invested in stocks in 2022, you've probably seen quite a hit to your portfolio. We've seen rising interest rates and negative GDP, and no, there's no recession yet, thankfully. Well, the job market is still strong. Last week, the July unemployment rate was reported to have fallen 0.1% to 3.5%, and this brings us to a 50-year low. And with all that, stocks in the first half of 2022 haven't been more volatile since the beginning of the pandemic. But it's not all that bad. It means that many of the stocks are now oversold, and that means that now you have a potential for a buying opportunity. Now look, I get it. Now might not be the right time for you to buy stocks. I get it. But it's funny, right? The stock market is the only market in the world that few people buy when stocks are on sale. Imagine for a moment you're going on holiday and you're watching the cost of the flight. And you have the money to buy it, but you don't pull the trigger because you think the price is too high. And so far, the flight is, $1,000. But today, it costs $700. And what do? You buy the flight. Probably. Well, it makes sense. But the same doesn't happen, well, at least not usually, with stocks. Oversold stocks present an opportunity for investors to capitalize on overcorrections. Investors can research companies using fundamental analysis and technical indicators to determine if a stock is oversold. In fact, many stock metrics can be used to identify the most oversold stocks. And the Relative Strength Index, or the RSI, is a popular starting point. Now, since you're looking for information on stocks for your retirement portfolio, I wanted to introduce SureDividend. SureDividend helps investors like you and I find high-quality income securities for their retirement and financial freedom portfolios. And the SureDividend newsletter does all the work for you. They analyze their top 10 high-quality dividend growth stocks each and every month. And it's an excellent product, which I use myself to research companies for the videos that I create on this channel. So, if you'd like to support the channel, I'd invite you to check out the link in the description below and hit the subscribe button. That way you'll never miss any of my future videos. And stay tuned because later on I'm going to be giving you a promo code worth a $41 discount off the SureDividend newsletter. Alright, so before we begin, RSI is known as a momentum oscillator that's calculated based on the intensity of recent price movements. The indicator is on a scale of 0 to 100, so a reading of 50 means neutral, and overbought stocks have a reading over 70, and stocks that are oversold have a reading of 30 or below. But it's important to recognize that not every oversold stock is undervalued or a strong buy. For this video, the RSI data is provided by bar chart. Bar chart connects directly to markets, equities, futures, options, indices, and foreign exchange markets, as well as dozens of news providers and other data services. And I like bar chart as a place to grab quick information about stocks that I research for this channel. So if you want to go take a look and support the channel, take a look because I've left you a link in the description below. Alright, so the following 10 companies represent the most oversold stocks in the S&P 500 as determined by the 14-day RSI. Consider industry headwinds, company guidance, analyst ratings, and target prices to identify stocks worth adding to your portfolio. First up, we have Cincinnati Financial, a property casualty insurer that was founded in Ohio in 1950. The company competes in a highly competitive marketplace across 5 segments: commercial lines insurance, personal lines insurance, excess and surplus lines insurance, in life insurance, and investments. Independent insurance agencies in 46 states market these products. Recently, Cincinnati Financial reported disappointing second quarter earnings, causing the stock to plunge more than 13% and into oversold territory. Adjusted operating income came in at just 65 cents a share, compared to analyst estimates of $1.04 and last year's Q2 performance of $1.79. And due to increased catastrophes, the company paid out more money in claims than it earned in premiums in the second quarter, for a combined ratio of over 103%. However, their CEO thinks that the full year ratio is going to fall into the mid-90s. Cincinnati Financial's RSI is hovering just above the oversold area at 30.14. Next up, we have Newmont Mining, the largest US-based gold company and the only gold producer listed in the S&P 500. The company also mines copper, silver, zinc, and lead. Newmont operates or holds assets in Canada, the United States, Mexico, Dominican Republic, Peru, Argentina, Chile, Australia, Ghana, and so many others. After sharing its Q2 earnings update, the company's stock price went down nearly 15%. Although gold equivalent production and commodity prices were up slightly, Newmont has faced inflation-related operating cost increases. From labor costs to diesel fuel to the steel used in mining equipment, the company saw its profits fall by over 40%. To combat rising costs, the company is shifting production away from its Colorado mine and towards a cheaper West Africa mine. This change should allow for more efficient and economical mining. And if material costs level out due to recession fears, Newmont may be able to recover its squeezed margins. The company is currently oversold with an RSI reading of 22.81. Next up, we have Baxter International. This is a company that develops healthcare products in hospitals, nursing homes, doctors' offices, rehabilitation centers, and others. The company offers various devices, software, communications, and integration technologies to support dialysis and intravenous therapies, surgical procedures, and critical care. Baxter International sells through both a direct sales force as well as independent distributors. Baxter International is one of the most oversold stocks because, like the other companies on this list, its stock tumbled 9% after announcing its second quarter financials. Now, while the top-line revenue increased 21% year over year, most of the growth came from the company's 2021 acquisition of Hillrom. Baxter's core business grew only 3% and saw slight declines in its acute therapies and biopharma solution segments. Further, the company revised its full-year guidance, with adjusted earnings per share now expected to report 10% lower than what was previously thought. And the company's CEO blamed unprecedented macroeconomic headwinds for the company's challenges. Baxter's ability to rebound from its slowing growth and supply chain woes will dictate whether or not the stock is truly undervalued at current levels. And their current RSI is 25.2. Next up, we have Stanley Black & Decker, a tools business that offers professional, consumer, and industrial product lines. The professional and consumer segments include power tools, pneumatic tools, as well as storage products. The industrial line sells automatic doors, pipeline and hydraulic tools, and heavy equipment attachment tools. Now, this company is teetering just above oversold territory, and Stanley Black & Decker is worth keeping an eye on after its most recent earnings report. Now, due to inflation, rising interest rates, and softening demands, the company's free cash flow swung to a negative rate in the second quarter. Executives also lowered annual guidance for 2022 earnings per share by nearly 50%, driving the company's share price down 20% over the last couple of weeks. However, there are reasons to own Stanley Black & Decker stock. For one, the company is a dividend king that currently pays a $3.20 annual dividend, corresponding to a 3.4% dividend yield. Furthermore, the company is divesting non-core assets to free up cash and striving to raise prices and clean up its supply chain. And if Stanley Black & Decker is successful and able to recover its margins, the company is just trading at 9 times next year's earnings estimates, so this could be a good thing. But today, the company's RSI is showing currently at 34.79. Next up, we have Everest Re Group, a reinsurance and insurance business that's headquartered in Bermuda. The company was founded in 1973, and today Everest primarily offers property and casualty reinsurance and insurance through brokers, general agents, and direct relationships. Also, Everest sells other types of insurances, including medical malpractice, directors and officers liability, errors and omissions liability, workers' compensation, and others. Although Everest is not technically oversold, investors might consider buying the stock after its recent weakness. Despite gross written premiums growing 8% year over year in Q2, net operating income declined 33% due to elevated claims for catastrophe events. And these results pulled the stock down approximately 7%. However, on their second quarter earnings call, their CEO highlighted many of Everest's recent wins. For example, they expanded margins across their insurance and reinsurance businesses with disciplined growth, continued to scale their insurance platform, and reinsurance capitalized on strategic market opportunities that improved the diversity and economics of their book while reducing volatility. Everest Re Group's RSI is currently 39.53. Next on the list, we have AT&T, a company that provides worldwide telecommunications, media, and technology services under the AT&T, Cricket, AT&T Prepaid, and AT&T Fiber brands. The company sells wireless voice and data services, handsets, data cards, internet-enabled devices, and protective cases in stores through agents and third parties. AT&T also offers cloud solutions, security, and equipment to businesses and governments of all sizes. After beating second quarter earnings per share expectations by 5%, the company decreased its full-year free cash flow guidance due to investment in 5G infrastructure and working capital. Now, for those of you that have followed this channel, you'll know that AT&T used to be a dividend aristocrat. But that all changed after the company's reorganization and spin-off of Warner Media back in April. As a result, the quarterly dividend was cut from 52 cents to 27.8 cents. That said, many of AT&T investors are still attracted to its $1.11 annual dividend, which today is just over a 6% yield from its last closing price. And with a projected free cash flow of $14 billion and only $8.5 billion of that income allocated to dividends, well, analysts feel that the recent decline is probably an overreaction. AT&T's RSI is coming in at 33.17. Next up, we have LOEWS. Now, be careful, this is not Lowe's Companies, the home improvement retailer. Rather, it's Lowe's Corporation, the commercial property and casualty insurance company that's headquartered in New York City. The business sells specialty insurance products and loss-sensitive insurance programs through independent agents, brokers, and managing underwriters. Lowe's is also involved in transporting and storing natural gas, operating 26 hotels, and producing a wide range of plastic containers and materials. Like others on this list, Lowe's reported disappointing second quarter earnings of $180 million versus $316 million in the second quarter of last year. This decline can be attributed to lower net income from joint stock investments, especially compared to 2021. And Lowe's RSI is 36.66. Next up, we have Incyte, a biopharmaceutical company specializing in the discovery, development, and commercialization of therapeutic treatments for certain types of tumors and cancer. Incyte also has several products that are in phase 2 and 3 clinical trials. Incyte has outperformed by more than 27% year-to-date compared to its industry peers. Plus, Incyte posted a second quarter sales and earnings beat on the back of continued growth from Jakafi, the company's biggest moneymaker. Nonetheless, the company recently fell below its 200-day moving average and is nearing oversold territory. Incyte's RSI is currently 33.13. Next on the list, we have Verizon Communications, a diversified telecom business that supports over 115 million wireless retail connections, 7 million broadband connections, and 4 million Fios video connections. The company serves consumers with internet access, wireless equipment, and smartphones, as well as businesses with cloud connectivity, private networking, as well as unified communication tools. After posting its most recent second quarter earnings result, Verizon's share price fell to a 5-year low. Revenue was flat and earnings missed slightly, but executives significantly reduced their guidance, and that indicated that Verizon's near-term growth may have stalled out. That being said, some investors are beginning to note the appeal of Verizon's fundamentals. With arguably the best network among wireless providers and a dividend yield of 5.76%, a trailing PE ratio of 8.26, well, the stock has rallied off their near recent lows. That said, Verizon's RSI is 33.38. Last but not least, we have Comcast, a media and technology conglomerate that operates in 5 key segments: cable communications, media, studios, theme parks, and Sky. Cable communications includes the traditional broadband, voice, video, and wireless services that residential and business companies access through Xfinity. Media includes cable networks like NBC Universal, Telemundo, and Peacock. And studios covers the corresponding studio production and distribution arm. Theme parks refers to the company's 4 Universal theme parks. And the Sky segment offers direct-to-consumer phone services. Comcast posted better than expected second quarter earnings, but has underperformed the S&P 500 by about 6.5% over the past 3 months. Although signs point to slowing growth, Comcast is nearing oversold levels. Any further pessimism could create an opportunity to bet on Comcast's healthy cash flow, given its cheap trailing PE ratio of 11 and a current dividend yield of 2.77. And Comcast's RSI is currently at 40.39. So there we have it. So we've all heard the term buy low and sell high. And when stocks are oversold, they can present an opportunity for investors to pick them up at a discounted price. But as I said before, be careful. Just because they're cheap doesn't mean they're worth buying. And that's why technical indicators aren't the be-all and end-all. So be sure to check the company's fundamentals as well. Do you own any of the stocks I talked about in this video? Let me know in the comments below and why you do or don't, because I love reading and responding to every one of your comments. Thanks so much for watching, and I'll see you in another video. Bye.